Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, August 11th. For the better part of the past 7 years, the dollar has been a punching bag for currency traders. In recent weeks, however, the dollar has fought back. On August 8th, the dollar index rallied 1.74%, its biggest gain in 6 years against a basket of other major currencies. At the August 8th close of 75.845, the dollar index was up 6.4% from its July 15th intraday low. The dollar's reversal of fortune has coincided with the resurgent stock market in the United States and European Central Bank President Trichet having acknowledged the weakening growth in Europe. Trichet's acknowledgement prompted traders to think the ECB won't be hiking rates further to fight inflation. Although the latest directive from the FOMC implied the Fed won't be hiking rates anytime soon, it did not hurt the dollar in this instance. The reason being is that even if the Fed stands pat for some time, it is presumed the interest rate differential between Europe and the United States will be narrowing, with the ECB likely to cut rates before the FOMC raises rates. Ultimately, that may not happen, yet it is that type of thinking that has convinced many traders to unwind what had been an easy money, long trade in the euro. The depressed dollar has been a beneficiary of that move. There are a number of macro factors that come into play with currency trading. The point of the discussion here is to highlight how a stronger dollar isn't necessarily a distinct positive for the market. Net exports, aided by a weakening dollar, have been an important component for GDP growth in the midst of the housing downturn. To that end, residential construction subtracted 0.6% from second quarter real GDP growth, while net exports added 2.4%. A stronger dollar curtails the positive impact net exports have on GDP growth, since it makes U.S.-made goods more expensive for foreign buyers and thus lessens foreign demand. In turn, the weaker dollar has been an earnings boon for multinational companies in the face of soft domestic demand. A stronger dollar will remove that earnings tailwind, making earnings comparisons more challenging in coming periods, particularly if demand in the U.S. remains sluggish and global economies continue to slow. One still needs to be careful about making too much of the dollar's recent rally as being a distinct negative for the economy and earnings. After all, despite the recent move, the average level of the dollar index in the current quarter is still 9% below the average level seen a year ago. That suggests it will remain a certain source of support for the economy and earnings in the near term. Also, don't forget that a stronger dollar is helping to bring down the prices of dollar-denominated commodities, which should help lessen inflation pressures and bolster consumption, both encouraging happenings as it relates to economic prospects. In thinking of the dollar, the key consideration now when looking ahead is that it isn't likely to provide the tailwind it once did for net export growth and earnings growth for multinational companies. That's okay if domestic demand increases and the U.S. housing market begins to recover. Absent those forces, though, a dollar strengthening purely on an interest rate differential trade would be more of a curse than a blessing for GDP and earnings prospects. I'm Pat O'Hare for Briefing.com. Thanks for listening.